Hi, everyone. This is Jason Breck of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. We're recording this interview on Monday, June 16th, 2025. Today's special guest is a returning guest. He's one of our most requested guests. I pepper him with tons of questions about mining stocks, junior miners. He has decades of experience covering and funding a lot of these mines into production over the years. He's a former vice president at Sprott Inc. He also started his own firm, which was later bought out by Sprott Inc. Excuse me. He is a credit analyst. So he looks at the balance sheets of these mining companies, potentially the economics of a mine, whether or not it can go into production at the current mine price, or if it's a turnaround play. And we're going to ask him about some of these turnaround plays in different commodities. Rick Roll, thank you for joining me again.
Pleasure to be back with you, Jason. Thank you.
Yes, and very interesting times right now. So we were talking before we started recording. I mean, some of these large cap mining stocks, whether that's a Wheaton Precious Metals, a Cameco, these companies are doing superbly. Cameco is up, I think, 8x from the bottom in 2020, 2021 when it was stuck in a trending range, and I was getting, hate mail about it. How dare you say anything nice about Cameco? Uranium's dead. I hate it. I hate it. Wheaton Precious Metals was absolutely hated. And now Wheaton Precious Metals is up like 6x in almost a little under 15 years with dividend increases. So I would say there's pretty good evidence that we're starting a bull market.
We're in a bull market, likely a quarter to a third of the way through, but we're in a bull market that likely continues. Jason, you made a lot of good points in that opening. One is betting against sentiment. In natural resource-based businesses, you are either contrarian or you are going to be a victim. One of the things that I did when I owned and ran a large natural resources brokerage is that I always played against extremes in sentiment. So I would walk into my trading cage, and whenever the buy tickets were 4 times the selling tickets, in other words, where 80% of the transaction volume was buys, I'd make myself sell something the next day. Whenever the sell tickets were 80% of total tickets by number, if the sell tickets were 80%, I'd buy something the next day. Betting against sentiment, if you trade, and I'm not really a trader, is surefire. The hate that uranium saw at the transition to this decade, and then saw again, frankly, 4 or 6 months ago, is a absolutely wonderful contrarian signal. The second point you made, though, is, and I remember talking to you about this, bull markets are always led by the commodity. The momentum has to be established by the commodity. When that happens, 2 things happen. Sentiment towards the commodity changes, which is to say the price momentum verifies the narrative. At the same time, the increased selling price of the commodity, if it increases faster than the cost to produce the commodity increases, begins to generate much more explosive producer margins, which is precisely what we've seen in companies like Agnico. So this bull market is following a very predictable path. We don't need to ask ourselves anymore, are we in a precious metals bull market? The evidence is clear.
And we're seeing that with the quarters now, over 12 months now of really good quarters, I would say, where you're not having like really bad surprises as we saw in the past, Rick, where some of these earnings calls would just be absolutely horrible. There'd be a surprise 20 or 30% increase in the cost, and the free cash flow would not be there.
You will remember the frustration we all felt in 2023 and 2024, where the gold price increased, but the margins didn't. In those 2 years, the inflation in the input costs, particularly the energy input costs, that increased faster, and labor and tax, frankly, than the gold price did. Inflationary cost pressures in the gold industry in terms of input were largely over in the beginning of 2024. The increase in the gold price that we saw in 2024 was unanswered by increases in cost inputs. And so you've seen absolutely blowout margin. What you see from a quantitative point of view on a discounted net present value basis is if you look at Agnico Eagle, the price of the shares relative to the net present value of their cash flows in 2024 being cheaper today after the share price has doubled. That's how dramatic the increase in the net present value of free cash flows is, with the margin increases that have been brought about by commodity price rises. Now, clearly, in order to buy into that, you have to believe that the gold price at least holds steady as opposed to go up. But it's important to note that a credit analyst, a fundamental analyst, when he or she does a net present value at today's gold prices, finds that even some of the best that have doubled in price are arithmetically cheaper now than they were then.
In your opinion, where should these mining companies, gold and silver miners with free cash flow, where should they be allocating the free cash flow?
Companies that have variable rate debt should fix that. Uh, Traditionally, periods of time where you see inflationary cost pressures in the broad economy means that you have over time increasing interest rates and you have a decreased availability of capital. So companies that have working capital deficits or excessive debt relative to equity, or in particular floating rate debt or debt that matures inside the 5-year time frame, need to use this free cash flow to address that. The second thing that they need to do, and they've been very cautious with regards to capital expenditure for the last 7 years, they need to pay attention to maturing their development pipeline. Remember, Jason, that every day that you mine, your business gets smaller. Mines don't get bigger. You can discover more rock in the existing mine, but they don't get bigger. So it's important to look at these things not just from an earnings standpoint, but rather from a net present value standpoint. And maintaining production in the out years is something that requires capital investment today. Important to do that.
Is there enough free cash flow to go around, Rick, where, say, a company like Agnico Eagle or Alamos Gold that has lower costs relative to a lot of their peers, they have enough free cash flow for almost everything that they want to fund? If they want to announce like a variable dividend increase, if they think their stock is cheap, they were doing share buybacks the last 6 to 12 months. They have money to reinvest into property, plant, and equipment, say like a mill expansion, an existing mine. They have money to spend on exploration, and they also have money for acquisitions. Is there enough free cash flow for some of these low-cost miners to do stuff like that? All of the above?
I can't speak to Alamos, but I'm very recently done having an in-depth session with Agnico Eagle management, and they're swimming in cash. They have they have a wonderful development pipeline, and it's fully funded. They will do acquisitions if they see something that's accretive on a per share basis. But even after improving their balance sheet, which they've largely done, funding their development pipeline, they are going to have cash available to distribute. The choice is going to have to be between distributing that free cash flow by way of, as you suggest, a variable dividend, or whether it's best spent reducing shares. From a tax efficient point of view, retiring existing capital that is buying in shares is usually more efficient for the shareholder than increasing dividends, because he or she is taxed at the capital gains rate rather than at the ordinary income rate.
Yeah, and dividends, like for our listeners out there who are not as familiar, if you're an American citizen, I mean, some of your dividends, by the time it's corporate taxes and dividend taxes, your dividends are like triple tax, basically.
Correct.
Yeah.
Correct.
Whereas with if the share buybacks are strategic, so I would argue that, like you said, I'm in the David Einhorn camp, just like you, where if they think the stock is cheap, it's yeah, share buybacks for share buybacks sake. If the management team is just doing them to get earnings per share beats, then I would take issue with that. But if they think their stock is cheap on a operating cash flow valuation metric or a discounted cash flow net present value or net asset value, whichever the industry uses, they can justify that. Then I think those are share buybacks are smart long term.
My former partner, Peter Grosskopf, a noted natural resource investment banker, has suggested that if a company is generating substantial free cash, even if the share buyback isn't on a per share basis accretive, as long as it isn't too dilutive, it's a good thing to do. That it over time inures to the financial brand and over time reduces the cost of capital to the issuer. That's a very interesting argument. He says that you don't want to deplete your capital base if the share buyback is dilutive to existing shareholders. But if it's flat and you have surplus capital, it's still a good use of funds.
The S&P 500, I mean, I think, unfortunately, they do that to get earnings per share beats so they can trigger their stock options. So I don't think they look at valuation metrics.
Yeah, and the gold industry was very guilty of that same statistic in the period 2000 to 2010. It's not uncommon for an industry in favor to utilize the balance sheet and the income statement to fatten the stock options and total compensation of management.
So I've been getting a lot of questions about this, Rick. At $36 silver, are a lot of the primary silver miners, are they making good free cash flow right now? And are they going to start looking like Pan American Silver at going and buying additional silver mines like MAG? Are we going to see more of that now?
Two different questions. Uh, Free cash flow is a statement that needs defining. Too many investors, and frankly, too many securities analysts, look at all-in sustaining cost as the be-all and end-all on the income statement, and that's wrong. Uh, to begin with, AISC doesn't take into account tax, and I'm not really interested in a pre-tax discussion of cash flow. All-in sustaining costs, and this next point is very technical, but it's very real, doesn't include cost of capital. When most primary silver producers who are not investment grade companies borrow money to put a project in production, that debt cost may read 9%, but it's actually 15%. So if you add back that cost of capital, including the net present value of the shares that you sold, the dilution that you incur, that's a real cost. Finally, in periods like 2020, 2021, when the industry was suffering through very low precious metals prices, oftentimes precious metals producers high graded. You see this on the income statement and the balance sheet, where the grade of material that was produced during a period in time in low metal prices was higher, materially higher than the average life of mine grade. Companies are unfortunately under GAAP not required to report excess depletion on a unit of production value. If they have 10 million tons and they produce a million tons, they do depletion on a tons basis, not ton times grade basis. So when you use the phrase free cash flow, you have to be very careful. There are periods of time, and there are issuers today. Alamos, you mentioned. Agnico Eagle, you mentioned. Lundin Gold. Even coming down the quality trail, companies like Oceanic Gold that are producing substantial free cash flow by any metric. And I suspect that for those companies, if they have a disciplined capital allocation process, that the cheapest ounces will be debottlenecking existing production, moving forward production that otherwise would have occurred 5 years from now and have it occur 2 years from now. Debottlenecking mills, certainly right now, increasing sustaining capital expenditure, pre-strip, stuff like that. The second thing to do, once you've exhausted all of the organic needs in your business, is to begin to focus outside your company. Look for assets that you can acquire that are really, truly accretive, not just about mass, but as an example, an adjacent deposit that likely can't be put into production because it won't stand a production facility of its own, a mill of its own. But if you buy it and you can run it through your existing facility, you can make a deposit economic where it was uneconomic on a standalone basis. The third form of merger, and you have to be very clever to pull this off, there's lots of things that can go wrong, are simply acquisitions for scale. The acquisition or the merger, pardon me, of Equinox and Calibre weren't particularly synergistic from an operational standpoint, but they give the resulting company substantially larger cash flow relative to G&A, and they also give the company simple heft, larger market capitalization, increased trading liquidity, which should result in them getting more index and passive buying and should raise the share price. Obviously, for me, my favorite use of cash would be organic expansion, particularly one that lowers costs or moves forward profit. The second would be strategic acquisition, where there are true synergies, usually locational synergies. The third would be heft transactions.
So to add to your points, there some of the acquisitions case studies. I mean, Agnico Eagle, they were buying assets around Canadian Malartic over the last 6 to 12 months before some of these valuations on the miners has started to move. So they were buying up. They were either locking in joint venture deals or they were actually buying like the assets all around the Canadian Malartic mine. And then the other one is Goldfields, what around the Windfall mine in Quebec. They locked up that deal in the bear market with Bonterra. They locked up the majority of all the surrounding land package around the Windfall mine in Quebec.
I think that you're going to see a lot of strategic acquisition happen in the Canadian Abitibi, either Ontario or Quebec. There are any number of discrete 500,000 or 600,000 ounce deposits, even a couple 1.2, 1.3 million ounce deposits that even at 35 or $3,600 gold likely won't stand the construction of processing equipment, specifically a mill, but are within 10 or 20K of an existing facility. If what you have to do with that deposit is permit it, finance it, mine it, and then process it at your host facility, what is for a little junior an uneconomic deposit can be for you pretty accretive. In the case of Malartic, there's a mill that with a little bit of work probably has 30,000 tons a day of excess capacity. And that is an area that is particularly ripe with regards to small satellite deposits that are not economic on a standalone basis, but assets that would absolutely positively scream being run through existing infrastructure. And I think you're going to see a lot of that, which is great.
Are there a lot of economic silver mines, say of 100 million ounces or more, that are economic around this silver price, or do you think that we need to see a higher silver price before some of these mines get built?
There are five that I know of that are economic at these prices that aren't developed. There's probably more. Um,
Yeah, because the acquisitions that we've seen lately, they haven't been for mines that need to be under construction. They're already producing, right? With Juancipio, Mag Silver, and Coeur d'Alene bought Silvercrest, so they're already producing mines.
and First Majestic bought Gatos. In the case of the SilverQuest acquisition, the Gatos acquisition, what investors need to be afraid of or concerned about is that in both cases, the acquirers got substantial free cash flow right now. But both of these have fairly short mine lives. And if you are not capable of replacing the ounces that you produce or using the cash flow in an accretive method, from a net present value standpoint, those were very, very full priced acquisitions. The acquisition by Pan American of MAG is a little different, both in terms of the net present value of the accretion relative to the net present value of Pan American. That was probably a flat transaction. What Pan American got for free was extension along strike, exploration along strike, which I think is big, exploration at depth, which I think is big, and the possibility or perhaps even the probability of parallel structures. If you look at the exploration and development that's taken place along Juanicipio and you compare it with the work that's been done at the Fresnillo vein, Juanicipio being the strike extension, you see that there's an awful lot of exploration potential on the ground that Pan American got as they acquired MAG.
And the new deal that was announced last week, didn't Dundee Precious Metals, which had a producing gold mine, which didn't have a lot of reserves, didn't they just buy a large silver mine?
They did. They bought a large polymetallic mine. In a good acquisition, I think, because the Dundee people understand how to operate in Eastern Europe, and they understand how to operate volcanogenic massive sulfides. They also understand how to mine and process refractory ore, and some of the ore from the mine that they acquired is likely refractory. I think this is a very, very good transaction for both parties.
One of my friends ran a report, a Wall Street analyst report from ChatGPT, the deep research one, the pro version, and it came out with like a saying how good the deal was accretive on paper. It was like a 5-page report, so it's really
Yep.
really good, and it was written all by artificial intelligence. It sounded exactly like a Wall Street analyst would have wrote it going through the deal.
Begging to differ, most Wall Street analysts write lousy reports. So I hope that artificial intelligence wrote a better report than you would have seen from Wall Street.
Well, it sounded like a human wrote it, so I guess like maybe then it's copied bits and pieces from other
Yep.
Wall Street analyst reports to make it sound
Yep.
like a human wrote it, but it did sound like it didn't sound like it was a robot, an artificial intelligence software program, a bot that that wrote it. It wasn't like bad grammar or anything like that. It was actually well written.
Great. Well, I happen to agree with the conclusion. My agreement has nothing to do with, well, unless you consider my intelligence to be artificial. But
Well, it's getting to the software is improving to PhD level, they say in the next like couple of years. So we'll have
right.
to see like for computer programming and other stuff. I know they're already replacing legal research. And the CEO of Goldman Sachs said that the artificial intelligence software can do about 90% of the work of a initial public offering prospectus. What used to take months, it can do in like an hour.
They can do it better, frankly. Let me tell you something about from my past, Jason. Uh, when I would do by hand securities analysis and credit analysis, it's a long time ago now, but I used to take 5 years of quarterly reports. The first thing you do is pull the staples out, and then you lay them on a conference table. And to take me to do one company would take me an hour and a half a day for 6 weeks. Uh, Once Bloomberg came around, I could program Bloomberg to do that for me. I would press a button, and it would take about 2.5 minutes. But the only database that I could search was the Bloomberg database. With artificial intelligence, I can't do that, but with an intern's help, I can cause multiple database searches, and I can cause that to occur in about a minute. What I can do now that I couldn't do at all 30 years ago is I can program for various factors that I consider to be important, and I can compare 20 companies across various metrics. And I can change the weighting on the metrics if I want to. The ability to do that was simply not available to me 30 years ago. I couldn't do it. So it isn't a case of AI being better for me. What it does is open up the probability of factors based due diligence, comparative due diligence, that was absolutely positively unavailable to me. The
Yeah,
second thing that AI can do in mining, it's doing it in oil and gas right now, is what's called coincident anomaly concurrences. In exploration, you look at a bunch of different indicators. It might be surface mineralization, it might be geophysics, it might be major structure. There's a whole bunch of things you look at. Uh, and what artificial intelligence is able to do is look at all of them, synthesize them, and put them in effect in an integrated heat map and look for areas where out of perhaps 10 anomalies, that 5 or 6 of them are coincident in one location. Uh, this it doesn't enable you to find a deposit, but what it does enable you to do is take maybe 2,000 square miles of a district and narrow your search down to 1 or 2 square miles. This
So
is
it
amazing.
increases the probability. You're saying it will allow geologists or the people in charge of the drilling program to be more productive, be more efficient with the capital.
Yeah, and even refine where you look. If you take a 2,000 square mile block and you reduce the scope of search to 500 acres, you may have saved yourself 3 decades.
And millions of dollars in drill program, yeah.
Correct.
Okay, so you brought up five silver deposits that are economic. Are these in countries like Argentina, Mexico? Are they in geopolitically safe countries, or are they in like Latin America? Are they in any specific country?
I don't think that there are any politically safe countries at all. So let's talk about that first. The most obvious, Cascabel, is in Guatemala, and it faces substantial recent political risk. The second would be Navidad in Argentina, where the circumstance is improving, but where historically the state government, where the deposit is located in, has been anti mining and corrupt, which is problematic from my viewpoint.
Yeah, worst combo.
Yeah. I mean, the most proximal to production ex political risk would be Cascabel because it's been producing. The facilities there, the mines built, all that kind of stuff. It's shut down. The
Is that next to
Abrasil,
Escobal?
pardon me?
Is Cascabel, is that in Guatemala? You said, is that
Yeah,
next to the Escobal mine, that Pan
same
American Silver?
deposit. Same deposit. Depends on how
Okay.
you call it.
Okay.
Same deposit. The next one that I would draw attention to, the next three are much lower quality, but still very high quality deposits relative to the first two. They would include the Abrasilver Diablios discovery in Argentina. Greenfield's discovery, fairly high, fairly remote, but the increase in mining activity, particularly around lithium in the Salta Altiplano, has meant that developments coming towards the deposit. The discovery looks to host in all categories 250 to 300 million ounces. Exploration has become predictive. I'm quite attracted to it. I'm certain it works at this gold price with this cost of capital. There's going to be a couple more years of drilling to determine how you optimize that deposit. A different one would be the Vizsla silver deposit in Mexico. Again, 300 or so million ounces in all categories, will get bigger, will also get richer. In Mexico, which has real both political and social risks. The third would be a deposit that I can't pronounce in Morocco, being advanced to production by Aya Gold and Silver. Again, this looks to be a 250 or 300 million ounce producer. Good size, good geometry, good grade. There are probably more. Those are the five that I understand well enough to describe them. There,
Didn't Karani have a lot of silver byproduct that was in Peru from Bear Creek mining? I mean, that thing has been delayed for 15 or 20 years. Wasn't there like a huge amount of political risk blocking those two mines from Bear Creek?
there's another problem there, which is those are immense deposits, much higher ounce totals than have been reported, but the grade is very, very low. Those have challenges that relate as much to economics as to politics, which is to say they're large scale mines and you'll have to run a lot of material through to make them work. And that means that your upfront capital costs are going to be very high. So, on a net present value basis, those deposits are more optionality plays. In other words, they make you a lot of money at higher silver prices, but they're marginal at best in this sort of pricing scenario.
Okay, Rick. So it sounds like not a lot of new silver supply is going to be coming online unless it's from an existing silver mine where there's like an expansion project of a mill or there's some exploration success.
That's correct.
So it could take many, many years for those additional silver mines. And we're looking at 5 or 10 years then. If the capital was invested today and the permits were approved, it would take at least probably at least 5 to 10 years probably to bring some of those larger mines online.
Correct.
And we're seeing like I don't know if you've seen some of the demand projections for silver. I mean, like the solar panels usage out of China and India, it's way higher than the projections.
That takes care of itself with a higher silver price. You need to know that. At a higher silver price, the fabricators will develop technologies that enable the use of less silver. The cure for high prices is always high prices. You either moderate supply or you reduce cost. The second thing that you have to look at with regards to the bull case for silver around supply shortages is that most silver isn't produced from silver mines. It's produced as a byproduct from mining other metals. And here's the rub, if we see steady to increasing copper prices, and if we are able to raise the money to build 6, 7, 8, 9, $10 billion porphyry copper deposits, the increase in byproduct silver from those will dwarf the silver production that will occur from primary silver producers. Primary silver producers produce at last count about 18% of primary silver supply. So although they're important to speculators, they're much less important to the silver market. What's more important to the silver market is recycling efficiency and byproduct production from copper, lead, zinc, and gold mines.
And if those byproduct silver is available for the mines, I mean, the royalty and streaming companies, the larger ones, the senior ones and the mid-tier ones, I mean, they'll be looking at funding the construction and development of those new mines and getting a gold or silver byproduct stream too.
Jason, it'll be a field day, an absolute field day. You just hit the nail on the head there. The byproduct silver revenue in a copper company is valued at a copper multiple, which is say they get 5 or 6 times the net present value of the free cash flow. That same silver production, isolated in a stream, sells for 12 to 15 times free cash flow. So somebody like Wheaton Precious can take 5% of the free cash flow of a mine, and they can cover 20 or 25% of the upfront capital cost of the mine. People misunderstand the importance of that in terms of the size of the prize, the opportunity set that are available to the streamers. One of the criticisms that you see of royalty and streaming companies is the analyst's suggestion that all the big transactions are in the past and that guys of the size of Franco-Nevada and Wheaton can't grow. And that supposition is wrong, wrong, wrong. They have the sophistication, they have the access to capital, and surprisingly, the access to opportunities in the next 10 years, so that literally the growth potential that's ahead of them is potentially larger than the growth potential that was behind them.
Yeah, all they have to do is just sit back and wait for some of these mining companies to have a balance sheet problem or a production problem at one of the mines where they need an emergency injection of capital, and the banks that maybe in the past would have given the miner some money, they're not going to give the miner the money for whatever reason, regulation Basel III. They don't like fossil fuel companies. They don't like mining companies using fossil fuels. And so the royalty and streaming companies are basically filling the gap that the banks would have in the past.
When I used to compete with either Franco or Wheaton in the capital stack when I was at Sprott, project finance off balance sheet, which is to say classic project finance, was about a 15% internal rate of return business or cost of capital business, if you looked at it from the issuer's viewpoint. Royalty and streams on a gross basis are a 6% cost of capital business. The royalty and streaming companies looking at the certainty of revenue, the upside available through exploration, that kind of thing. So in terms of the capital stack, assuming nothing else, it's the cheapest cost of capital available to you, especially if you believe your equity is undervalued. I have mining companies every day that tell me that their stock is selling at half what it's worth. If they have to use equity, the arithmetic cost of dilution, let's amortize the net present value of the discount over 7 years. That would suggest that at the onset your cost of capital using equity is 12%, as opposed to using 6% for a royalty and stream or 15% for project debt.
Yep.
That argues, particularly in the copper, lead, or zinc business, to financing as much of the construction as you possibly can through the sale of a byproduct silver credit.
And I remember when I was at Sprott headquarters, and you were there too in Toronto in 2014, 2016, because you flew me up there twice. And we are bringing up in front of you and the other Sprott executives that they should have launched a royalty and streaming company, a Sprott royalty company back then too, to do this as a side business where the Sprott Inc. owned some of the equity and you guys were also doing royalty and streaming, because that would have been the time to launch it, was during the bear market.
We tried to, this may be the first time I've ever admitted this. We tried to, when Sandstorm was an organization, raise the money and brand it Sprott Royalty. Mercifully for that young man, he had the good sense to ignore our blandishments.
You're saying you wanted him to be CEO of Sprott Royalty?
Yes, that's correct. That's correct. We watched what he did at Wheaton, liked him, and we wanted him to. I mean, even before that, frankly, we reached out to Doug Silver, but Doug Silver found a better backer in Triple Flag. Fast forward to today, and Sprott is in the royalty and streaming business on behalf of university endowments and pension plans, but privately.
I think they bought like $150-200 million stream, but I don't think it's going to cash flow for many years.
They bought the option on 2 streams.
Yeah, I mean they didn't listen to me. They were pretty anti royalty and streaming company. I think you and me were the only like pro royalty and streaming company people in the room back then. They were very anti a lot of the people I was talking to there.
Yeah, I mean, what you found with Sprott at that point in time, and in a sense, Sprott made the right decision, although I disagreed with it. The best business in the Sprott arsenal was and is their physical precious metals trust. Although they charge low fees, those are very high margin businesses. And Sprott has, over the duration of my being involved with them, taken assets under management in those trust businesses from about $1.5 billion to almost $40 billion.
Wow.
A 40 basis point or 0.4% fee on $40 billion, where you have almost no offsetting expenses, is extremely pleasant.
Well, and they're launching these physical trusts in bear markets too, Rick. Look at the uranium trust that was launched in the bear market, right? So, I mean, like that's had a lot of success. I see the uranium trust and the Sprott uranium miners ETF mentioned on TV almost every single day now.
I don't know if you saw that today they did a $200 million raise in the Sprott Physical Uranium Trust. 40 basis points. So let me see, 200 million. That's $800,000 a year in incremental management revenue with no offsetting expense. If you are selling at 12 times free, well, let's do 10 times free cash flow, which is low, but it's easy to do. That means that today, that raise generated $8 million in net present value for Sprott shareholders.
And maybe we'll see a rare earth physical trust too with strategic metals or a rare earth miner ETF launch too, so people get some diversified basket of commodity stocks like that.
Rare earth could probably work. What you need is a commodity with a high value relative to mass and weight. That's why you don't have an iron ETF. It's why a gold ETF works better than a silver ETF. Rare earths could work, assuming that you could buy enough heavy rare earths to make it worth your while. These trusts aren't really economic below $100 million in NAV. They may be in the case of Sprott because they can offset some of the overhead in their bigger products. But you need a commodity where it's valuable enough relative to its weight and mass that the storage costs don't eat your lunch. So rare earths, assuming that you could get them, would work well. What I suspect that Sprott will do in the rare earths, and I say suspect, I'm not an officer, director, or anything like that any longer. What I suspect that they'll do is rather than create a publicly trading trust, create a private partnership with institutional investors to buy and store strategic and industrial materials, which would be economic at much lower thresholds.
Well, they are doing some really good innovations. They've had a lot of these trusts and mining stock ETFs be successful. So they weren't
Absolutely.
maybe initially, but over the course of years, they've looked good. And they launched the copper one a couple years ago in the last year and a half, 18 months or something like that too.
Yeah, I'm more of a skeptic on the copper, simply because the price of copper relative to the storage expense, relative to its mass and weight, isn't very good. $4 a pound is not as good as $35 an ounce. If you juxtapose the price appreciation to the cost associated with holding it, I think that's a challenge. What they have done, and the market doesn't appreciate this, is they've developed an investor franchise of somewhere between 275 and 300,000 investors. And they have perfected the at the market form of financing, where rather than going to the underwriters, although they did that today in the Uranium Trust, but rather than going to the underwriters to raise money, by having an evergreen prospectus, they're allowed to tap the volume that happens on a day by day basis. And there have been some days when the at the market financing mechanism has allowed Sprott to raise $50 million into the Silver Trust, as an example, in one trading day. The consequence of that, as I say, is that their assets under management have grown dramatically, but their cost of launch are much less. Rather than being held to ransom by the investment banks, Sprott can go to their existing customer base, explain the thesis, and overcome the launch objection internally. That's very important.
Yeah, people have been skeptical about these physical metals trusts over the years, but the platinum and palladium one, I mean, that's going to start to gain popularity now with the rally in platinum and palladium prices. So I just like the innovation they're doing. Not everything they try is going to work, but overall, over the long term, I mean, they've had some successes launching these things a number of years later.
And the Physical Platinum and Palladium Trust has earned Sprott solid rents for the 12 years that they've waited for it to be successful. From Sprott's viewpoint, the opportunity cost is negative.
And I think that's why I enjoy being a Sprott Inc. shareholder, because I get commodities exposure there. The management team is picking out the different commodities and launching these products and trying it out. And you have a free cash flow business that just pays a dividend, and you get broad commodities exposure rather than picking out necessarily individual commodities.
Now, Jason, you absolutely named the thesis. I wasn't allowed to say this when I was a Sprott employee or director. But if you buy my trusts and you buy my ETFs, you pay me a fee. If you own the management company, you receive the dividend. Would you rather pay the fee or would you rather receive the dividend? Now, there's a case for each individual trust if you want to focus your money on one aspect of the market. But you can achieve portfolio diversification while at the same time receiving a dividend as opposed to paying the fee by buying the parent company. People listening to this discussion should note that while I'm not an officer or director or an employee of Sprott, I am their largest shareholder. So there's some conflict of interest built into that statement.
I like the company too long term. I've just buy and hold with that one because it's free cash flow and it's grown the dividends over the years. Now, I want to ask you about the laggards for the copper and gold companies, the mine companies, where there's production problems at a mine over the last year or two. The most recent one is Ivanhoe Mines. I know you're friends with Robert Friedland. They have really good assets, these low cost, high grade copper mines in Africa. They're about to bring online a world-class platinum and palladium mine. I think there's also a good amount of gold byproduct and base metals as well, called Platreef. Most of the mine is mechanized. The share price has gotten absolutely decimated over the last 6 or 7 months, mostly in the last couple of months, I think, because of the production problems at the mine in Africa. I've seen research reports, Rick, that are talking about that this mine is not fixable. In your opinion, is this mine fixable with the turnaround the producing copper mine?
Yes. The question is the period of time. You point out that they're bringing on new sources of free cash flow, but this is their source of free cash flow now. And this free cash flow at current production rates, at current costs, is non-existent. Two things. Between Kamoa and Kakula, I would estimate that there's a 33-year mine life. So what happens for the next 6 months is of interest to all of us for 6 months. 10 years from now, we'll look back and forgot this happened. What is going to happen, however, is that I shouldn't say is, what I'm afraid happens is that the seismic event occurred as a consequence of an improperly aggressive mining protocol. They mined too fast. They didn't leave enough crown pillars. This is ore left in place to support the hanging wall. And they probably weren't as aggressive enough with backfill as they should have been. I'm making this up, by the way. I don't know. But I suspect that they will have to mine much less aggressively, and that they'll have to leave more ore as support, and they'll have to be more aggressive with subsurface paste and other mechanisms, which will raise their production costs at the same time that it reduces their production. So I think you need to take that into account. I have myself suspended my rankings on Ivanhoe until I have better personal clarity, and I can reconstruct a net present value on Kamoa Kakula. I don't have the ability to do that right now because I have no idea what the new mining protocol will look like. I have no idea how much ore it will sterilize, and I have no idea what the new operating cost with the new support and paste and fill protocol will be.
So there's a ton of uncertainty because like I've seen some of the mining engineers comment on this online on mining stock Twitter. That some of them have even said that this mine is not fixable. So I mean, that's anyone saying anything like that, even if they don't have a lot of facts, if it's just their opinion, they haven't looked much at. I mean, that's going to scare a lot of people away, and that's why the stock is where it is right now.
Yeah, I think that the latter part I believe. I absolutely believe the mine is fixable. The Ivanhoe guys are very smart guys, and they're throwing money at it like there's no tomorrow. And the Zegen guys have gone over 25 years from being mining novices to mining pros. It may be that they spend the next 6 months backfilling the area of collapse. That would
Well,
be very expensive. But to say that a mine where the grade averages between 6 and 15 times the median grade mined worldwide is not fixable is a little silly.
Well, also 6 months from now, Rick, Platte Reef Phase 1 will be cash flowing, and then they will be ramping up to Phase 2, which is absolutely massive by, I think, like 2027. So, and that's going to be a world-class base metal mine with platinum, palladium, and gold byproduct.
And in addition to that, they're starting up the Kapushi mine, which is the highest grade zinc mine in the world.
Okay, so the market's not thinking about these other assets that are under construction right now that will be cash flowing, that will give Ivanhoe good diversification a couple of years from now. The market's just worried about the short term right now, and there's opportunity there.
The market won't give you will or could in a jurisdiction like the Congo or South Africa, where the market isn't sure whether the asset will be yours at that point in time. So I understand that. They're going to have to solve the production problem in the Congo so that they can say is as opposed to will. There are a lot of good things happening in Ivanhoe that people don't pay attention to. They are midway through the construction of a blister copper facility so that rather than selling concentrate, they'll be able to sell LME grade finished copper. Right now, their largest expense is trucking the copper concentrate from Katanga to the African coast to ship it to smelters. It is a lot more economic to ship copper than it is to ship copper concentrate. The second thing that's happening, second to the blister smelter, is the construction both of a hydroelectric facility and a finished ability to move this hydroelectric facility, which will dramatically and for a long time lower Ivanhoe's electricity costs. important changes, ones admittedly that people are paying no attention to, and perhaps they shouldn't, because what you worry about now is when you get some certainty on the net present value around the Kakula part of the Kamoa-Kakula project.
And there's rumors that some of the larger copper miners are out there looking for acquisitions too. Do you think that if Ivanhoe lags for a while, that a larger copper miner like a BHP or Rio Tinto will look at the quality of the assets and want to go buy it if it's deeply discounted?
Nope. Uh, you have a partner in there, Zijin, and you have a second partner, CITIC, the Sovereign Wealth Fund for the People's Republic of China. If Ivanhoe falters, it gets slopped up by China Inc. quickly.
Oh, because the quality of the assets in Africa, then they want to target what copper assets in Africa.
Xi Jinping's mandate is to obtain raw material supplies for China. They're already a shareholder and operator of this mine. The second largest shareholder is a related company, CITIC, China International Trade and Investment. If the Chinese had the ability to roll up Ivanhoe, believe me, they would do it.
The other laggard, Rick, I'm looking at a stock chart here, is SSR Mining. Even though the gold price has rallied a lot, the shares are still down about 40% since the around like early 2023. That was the Chopler incident. So do you think then that SSR Mining, they've been lagging for a while? I think they have the lowest free cash flow margins according to the Mining Journal. I think they're $500 an ounce or less of free cash flow right now. Do you think that that's a potential turnaround play, or do you think they're having serious issues there?
I think both. Potential turnaround play, yes. I think over time that they will likely be able to turn Turkey into a profit center as a loss center, although they have a lot of repair work to do with the Turkish government. While they're doing that, however, all of their capital is going into Turkey, and they've had to, I would suspect, defer sustaining capital investments in other parts of the world. When you defer sustaining capital investments, you impede your ability to do cost-effective production. And so, in addition to fixing Turkey, they're then going to have to return to making sustaining capital investments around the rest of the world. So they've got a year or 2 years worth of challenges. They're a highly qualified mining team, and I suspect they'll get through this. But they really got themselves behind the eight ball with the Chopler failure.
Yeah, and that delayed the construction start for Hod Maden. So the Turkish conglomerate, which is one of the largest corporations in Turkey, Lithium and Çelik, if there was any more delays, I think in the construction for Hod Maden, you would have maybe looked for Lydia to potentially replace SSR. But I think they're committing $100 million for construction capital expenditure for this year for 2025, and I think even more than that in 2026.
Exactly, and that's a truly superb deposit. It's just a wonderful deposit. And by the way, the Lydia guys are very high quality guys. I got to know them reasonably well.
Yeah, for the listeners out there, I mean, like the average person just sees that SSR Mining is the operator for Haman, but Lydia actually owns the majority, 60%, something like, I think over 50% they own of Haman. They're actually the main owner.
And although Silver Standard may be the operator, I suspect that Lydian is constructing it.
Okay, well, you have a conference coming up, and I'll attach a link to that. So please tell my listeners about the symposium.
The Rural Natural Resources Investment Symposium is held July 7th through 11 in Boca Raton. It is, I believe, the single finest natural resources investment event on the planet. That's backed up by the following guarantee, whether you attend live or via live stream. If you don't think that we have delivered you your money back, your tuition is 100% refundable. This event has no financial risk to you. There's no other investment conference in the world that I know of that has that much faith in their content, an absolute money back guarantee. Visit the website, learn who's going to be there, learn why, and remember, our conference, whether you attend live or live stream, has an absolute money back guarantee.